Good evening, everyone. Welcome to this webinar. I welcome Praveen Kumarji. Thank you so much for joining the speaker today. And the another speaker we have is Archana Bhutani. Thank you so much for always being available for any such important webinar. I must say that we have again the part two of the earlier webinar, key accounting considerations for the preparation and finalization of the financial statements for the year 23-24. I think most important and very apt at the right time, I believe, which we have taken this initiative. And of course, with your both of your support and availability and the time you've given to this webinar earlier and today, I think members have really benefited. And thank you, Madam Asha Sharma, for moderating this important webinar. We have Shalini and, of course, the IT support, which is there. So I think being part two, which should not spend much time in the introduction part, but definitely I would just like to share a couple of points from the accounting standard boards or the initiative. I would say that this being a very important webinar, but then in due course we have planned for a series of accounting standards webinar. So this is on that we had a lot of webinars on Ind AS, of course, which is important of the financial year. Even the accounting standard.
Abhay, your voice is breaking sometimes.
Learning and understanding for members. Okay. So, am I audible now?
Yes, right now audible.
Okay. So like I was saying that the accounting standard webinar, which we have planned, a series of webinars starting in the month of May. This is 5th of May. And we have the time in the evening, 5 to 8. We have planned on Saturday, Sunday. So very useful for members to attend, covering all the accounting standards, understanding of the accounting standards, and why these are important and relevant for preparation, presentation in the financial statements. More important, when we have already released the guidance note for the non-corporate entities, for the LLPs, and there are issues, understanding issues with respect to members who are undertaking the audit, that whether the applicability of these accounting standards or to what extent they are applicable to non-corporate entities also, I believe part will be then covered. So this course on Ind AS, maybe going future, we may have a certificate course for the accounting standards. And I think members, or I would say the experts like for me, and Archana so supportive, always been available, whether much I'm sure are again today.
So, Abhay sir, last 10 seconds we could not hear.
Yeah.
Last 10.
Yeah.
So I think sir have handed over to us. I guess.
Yeah. Over to you, Asha. Yes.
Yeah. Thanks, sir. So, namaste and very good evening to everyone. I welcome you all in this part two of key accounting consideration for preparation and finalization of financial statement. At the outset, I am once again thankful to the Accounting Standard Board of ICAI, its chairman Pramod Jain sir, vice chairman Abhay Chajar sir, and the entire team for giving me the opportunity to moderate the second part as well with our very eminent and expert panelists from our CA fraternity, Praveen sir and Archana ma'am. Friends, we all know the importance of correct financial statement with all the appropriate disclosures, presenting true and fair view of financial positions to its various stakeholders. In our previous webinar, part one, we will say, our learned panelists discussed various issues covering basic from the advanced, from basic to the advanced level. But still, there were many other peculiar issues also which we wanted to cover. And we also saw overwhelming response from our live audience, and we received more than 100 questions online. So, as promised by the ASB chairman, Pramod sir, and his team, we are here once again with our expert panelist. Uh, for today's session, we have designed the today's session also in the panel form. We have designed the questionnaire covering the remaining peculiar issues as well as the relevant and important questions which were posted by the live audience, and which we could not resolve on that date. So we have covered those queries also. And in case any of you missed the opportunity to watch the live webcast or want to revise, it can be viewed again on ICAI YouTube channel named ICAI CA Tube. And my request from audience today to post your queries, if any, and we will definitely try to get it resolved from our panelists as far as possible. And also, I would request our learned panelists today to please discuss the queries with respect to AS as well as Ind AS wherever feasible. Even though some of the questions are framed specifically or Ind AS based, but if there is any comparative view available under AS also, so please try to share your views on AS also. So with this, we will start our technical session right from the stage where we closed last time. And my first question will be from you, Praveen sir. Although it was touched upon last time, but we felt there is a need to discuss it in detail also. Sir, please share your views regarding finalization procedure for changes in employee benefit obligation and their impact on the balance sheet and income statement.
Yeah, thank you very much. And I'm grateful to the Accounting Standard Board, Pramod ji and Abhay ji for giving us this opportunity to discuss these points again. And as we had discussed last time and we emphasized again and again, I'll recap, this point that whatever we share on this webinar, these are our personal opinions and personal views. Before taking any official or professional call, I would recommend you should go through the literature of the institute. These are accounting standards, there are auditing standards, there are guidance notes, there are technical material, there are expert advisory committee opinions, there are announcements. So one must look into the official literature. The purpose of this webinar is that we can share our views from practical perspective, and these views can be aggressive, these views can be conservative, but these are personal views from any stretch of imagination. These views are not views of the Accounting Standard Board or the Institute of Chartered Accountants of India. These are very, very personal views, or even our own organizations also where we are working. These views might be different from the views which are being taken by our organizations where we work. So please look at it from a perspective of sharing knowledge and sharing experience, and also from point of view of listening to the views of other people as well. So having said that, on this employee benefit, there are accounting standards, there are AS 15, there is Ind AS 19, which gives a very, very detailed guidance on what kind of accounting has to be done when you are doing accounting for benefits which are being given to employees. So I'll give you one example to explain the situation. Let's say there's airlines which is giving free tickets to the employees. Now this ticket, let's say they give 10 tickets to each employee. So these tickets, if the employee will go out and purchase these tickets, probably, let's say, let's pick up a number that, for example, it is costing 10,000 rupees per ticket. So one perspective is that each employee is getting a benefit of 10 tickets into 10,000. And then there are employees. The second perspective is that how much is the cost of the company? And let's say that cost is 5,000 rupees. So each employee is given a benefit of 10 into 5,000, and then you can multiply with the number of employees. So when you look at the accounting standard, they ask you to account for employee benefit at a cost basis. But the accounting standards, they do not prohibit making a disclosure of sharing the fair value of these employee benefits. So the fair value might be more, the cost might be less. So when you read AS15, it gives you an impression that it has to be accounted for at the cost. And then once you read, the accounting standards in detail, it also does not prohibit a company to make a disclosure that, okay, if you do a fair valuation, this much the employee benefit. So these are kind of issues which will come when you are looking at employee benefits. But more importantly, in small and medium organizations, there are employees. And I think there is another question which is related to this only. So every employee who is working for an organization for a specific period and more, 5 years or more, that employee will be given kind of gratuity at the time of retirement or separation from the company. So even though it is supposed to be given when the person gets retired or when the person leaves the organization, but the cost relate to this period as well. So accounting standards ask you to make a provision and book the expenses which relates to this year. Because as per the framework of accounting standards, the accounting has to be done on accrual system, and whatever has accrued in the current year, that has to be taken into accounting. Now, how much is the amount? Because the gratuity will be calculated based on the last salary which that employee is taking. And you do not know whether the employee will leave in the next year or after 3 years or after 5 years or after 20 years. So there is a component of estimation which is going there. And there is a methodology through which the calculation is done that out of that amount, how much will be estimated cost which is related to this year, which will have various components, probability, factors, increments, all these things, how many people are leaving, all these things will be taken into account. So that's science, actuarial science, through which we come to a provision in the current year that is mentioned, and that is given in the accounting standard, that employees' ultimate benefits, retirement benefits, they have to be accounted for in the year in which they are getting accrued. Now there are different level of companies, different level of organization, different kind of organizations, and there are some small organization where number of employees are very less. So there is a guidance which is given in these accounting standards, AS15 and AS19, which talks about how to account for these benefits, retirement benefits, whether these are related to gratuity, whether these are related to leave encashment, or any other such component of employee benefit, which is supposed to be given, after the retirement. So larger organizations, they have to get the actuarial calculation done. And then the smaller organization where there are less than 10 employees, even then the estimates have to be done. So in case you are doing an audit of a proprietorship or a partnership or a company or a small company or a large company, you have to ensure that the disclosures of employee benefit related expenses, the disclosures, the policies, and these are all there in the notes to accounts. And also, you will need to have an amount which is appearing in the statement of profit and loss, which will be taken as expense of the year on accrual system of accounting. So in the last session, we discussed in detail about the new change which has come, which Archana will pick up in this session as well, that there is a change where the accounting policies, you will have to differentiate whether this is a significant accounting policy or a material accounting policy. So now this big change has come from this year, and you will need to understand what kind of disclosures you need to make. But it is for sure the accounting standards and Ind AS both require you to apply the principles of accrual based accounting based on accrual system of accounting. You have to account for employee benefit in the current year for the amount which is estimated or which is calculated on the basis of certain factors, how much relates to this year. And this employee benefit expense is directly going to affect the bottom line or the profitability or of the unit or the organization where the accounting is being done. So this is a very important aspect. And when we were talking to when we are talking to the regulators, or we were discussing it in the sessions, it appears that small and medium organizations, there is non-compliance of this accounting standards, which need to be brought out by the auditor by way of qualification in case these accounting standards are not being followed. So this is a very, very important aspect. And it has been spoken, it has been discussed, it has been debated at various platforms. So we again emphasize that please look into this aspect. Employee benefits have to be recorded. They have to be recorded on accrual system of accounting and accounting standard 15 if you are using the accounting standards, and Ind AS if you are using Ind AS. They give you very detailed guidance on what kind of calculation has to be done, whether you need to do actuarial calculations, and all those expenses will hit your P&L as well as your balance sheet. So I hope that clarifies the whole thing.
Absolutely, sir. We have one or two linked question with this. So I think I shall ask it right now itself. One question is ki if a company has only one employee, whether actuarial valuation is mandatory.
So less than 10 employees, actuarial valuation is not applicable. But then you have to see which framework they are preparing their account. If it is a company and if it is Ind AS, then there's a different position. But for proprietorship partnerships, you have a different accounting standards applicable.
If a company following accounting standard framework, then 10 is the number.
Yeah.
Okay. And for gratuity, if a company has less than 10 employees, whether gratuity is required to provide it for or not?
Yes, that has to be provided for. You have to do an estimation on the basis of which you will need to, like I mentioned earlier also, employee benefit, whatever relates to current year has to come into your accounting because of accrual system of accounting, which is given in the framework of accounting. The accounting standards, Ind AS, all, even IFRS or US GAAP. So you have to follow those accrual system of accounting, and you have to account for gratuity, leave encashment, or any other such benefits which you are going to give. There are procedures, there are methods which are given, disclosure requirements are there. So maybe we can have a complete 2 hours or maybe 4 hour session only on this standard.
Yes, absolutely. There is one more question, sir, regarding this employee benefit, related to this employee benefit. Will the accumulated medical leaves, which are not eligible for encashment, but can be accumulated over the years, be required to be valued on actuarial basis or provision to be taken thereof?
So I'm not sure what kind of medical leave is being spoken about, but the underlying principle remains the same. It's a accrual system of accounting. If an expense is going to come to the company in the future, how much it relates to the current year, that has to be accounted for.
So thank you, sir. Archana ma'am, would you like to add anything, or shall I proceed with another?
First of all, thank you so much. And I think Praveen ji has already set the context in terms of how the responses should be considered, and he's been very elaborate. I wouldn't want to kind of, I think it's such a big topic.
Yes.
And hats off to him for covering it like this. Uh, I think just one or two very small points which were coming to me when I was just listening to him. One is when you ask the question on employees less than 10 and so on, whether gratuity payable. See, I don't think he is answering on the legal. Legal, please see whether the law applies. You could have a legal obligation to pay gratuity, or you may voluntarily. Okay, you may have your own policy to say, even if it's one employee, I'll pay whatever. I don't think we are commenting on whether gratuity is applicable to you. The question is, if it is applicable to you,
Right.
then there is a tendency to believe, oh, I need to complete 5 years, only then does the employee become applicable. That is where the principle that Mr. Praveen mentioned becomes applicable, that it is accruing to you because of your 5 year service, not the fifth, and therefore you start accruing for it even from year one. So, but we're not commenting on when it is applicable. The other, I think, on the leave encashment also, while I think the person referred to medical leave, I think the more generic question is just leave encashment. Many companies have a policy that you can take X number of leaves, medical or otherwise. And I think probably in that context, so there is very good guidance available, and the term which is usually used is compensated absences. And it can be in two ways. It can be in cash or in non-cash. At times you can take extra leave. Like if I can carry forward, I can't in cash. I can take, but I can take additional leaves. The other is I can encash it. So the principles will slightly differ for each. And also, please look at the current non-current classification. It is different from the current non-current classification that we have for the balance sheet in general. So there are specific principles. If I recollect, it says whether it will be wholly used and so on. So there are special considerations there as well. So just be very careful on the current non-current, and they depending, because see, if I say that you are going to encash it versus if I say that you are going to use it, the measurement changes. So let's say if I am saying that the employee can avail an extra leave, there is no cash outgo. So at what value do I measure? Do I value it at their basic salary? Do I value it at their total package? All those things. So there are considerations in terms of how you measure, something which can be carried forward but not in cash. So there would be those considerations which you'll need to apply. And the last, my personal request would be, just in a way, adding on to what Mr. Praveen said, accrual, so be very careful also about bonus provisions and so on. And at year end, please be very, very, very careful about your actuarial assumptions. There is a tendency to you take an actuarial valuation and you put it in the file. Please look at those assumptions very, very prudently and very, kind of test them very carefully. And at times, slight change in an assumption can have a lot of implication. So yes, it's a specialized area. We do rely on the actuary, but that doesn't mean that you will not exercise due diligence in terms of the assumptions. I would just request that review those assumptions very carefully.
Very right said, ma'am. So moving on to the revenue or income side, my question is from you, ma'am. In case a company had earned only interest income from the FDs or loans which are other than a normal course of business, then whether it will be comes under the head revenue or the other income in our statement of profit and loss account.
So if I can just do a very simple answer, but then there are many other issues that this question raises. The simple answer is, you said, I'm getting it from loan which is not in the normal course. So if it is not in the normal course, therefore it cannot be revenue. Revenue is something that you earn in the ordinary course of business. That is your, that is what you are set up for. So if I'm not a financing entity which is in the business of either investing or lending, then of course it cannot be revenue. It will be other income. But having said that, I think there are many issues this raises, and I'm just quickly, what I can think of. One is, I expect such a situation either to be in the initial year when, let's say, the company is still, let's say the factory is getting ready, you have some surplus cash you've invested. Why would I lend? I don't. Okay. If I'm not into the business of financing, why would I be lending? Won't I need that cash for myself? So usually you've seen investments, at least in the initial year, when the company is under, like in the setting up process and the factory is being constructed or whatever, or it would be in situations wherein the entity has ceased operations, right? So you are continuing, there is still some surplus cash left. You may at times do, your intergroup lending. I'm presuming those should be short term. Why would I do long term? I don't know. Because if that is not my business, I mean, why would I do it? So be very careful before you say this is not part of my business. I think we would expect such a situation to be in very few circumstances, right? Like I said, maybe a company was set up, it has ceased operations, it is continuing to exist. Loan bothers me. I'm sorry to re-emphasize again and again, because if you see, that is where most of those issues have been identified, and that is why Caro has so many questions on loan. I can understand that either in the initial phase or let's say when I've ceased operations, I have some cash surplus which I can invest. Loan, the minute you say loan, if I've got so much of loan, I mean, why would I just keep so much of surplus and give loan to someone for 5 years? I mean, it just doesn't make sense. So I think that is where I would be very, I'm moving away from accounting, but saying, please look at the substance of those loans. Are you just being an intermediary? Are these being used to funnel out funds? If not, and if this is all that you are going to do year on year, then please see, maybe it has become your normal course of business. Okay. If that's what I do every year. So I'm just saying you'll also need to see. The second is that, if I have only finance income, and let's say, like I said, it depends. This question is very open-ended. In what circumstances am I like in such a situation? And if, let's say, I only have bank deposits or loans in my balance sheet, then do I become an NBFC? See, because NBFC, and like I said, it depends how often do you have this. Let's say this situation.
Sometimes business is not started yet, or
as I said, it should be. It can be temporary. I can understand, but then then I would not have. See, like you just said, business, and I will not start giving loan for 5 years.
Yeah, sure.
Because the business is going to start soon. 6 months, I need my own cash. Why would I? So that's why I said, what is bothering me is loan. I'm not bothered about FDR. You do a temporary investment and so on. But if you've got loans and if you've got this situation year on year, let's say 3 years or whatever, I would actually say, is it my normal business? I would also look at NBFC, because as you may be aware, if 50% of your assets are financial assets and 50% of your income is from financial assets, it's in a way, it's coming from that source. And based on your previous year financial statement, then you can be an NBFC, right? Now you may say, no, this is temporary. RBI has its own interpretations. I'm just saying, this situation continues, you need to be careful on that. The other is that, yes, very simple, like I said, it will be fine. It will be other income, but also in AS, there is not so much of disclosure requirements, this thing specified. But in NDS, if you'll go, there are, when it comes to finance expense, there is a specific requirement in Schedule 3, okay, whether you're in AS or NDS to make those disclosures. When you come to the standards are relatively silent. But when you come in AS, but when you come to Ind AS, Ind AS has certain specific requirement of disclosure of financial income. So one is, when I look at Ind AS 1, if something is material, I can bring it on the face of the P&L. It will depend upon facts and circumstances. Or otherwise, let's say if I've got other income and when I give the schedule to the other income, I will typically have finance income there. And in Ind AS, certain disclosure requirements are mandatory. If you go to Ind AS 107, there is specific requirement to show, finance income from certain types of assets measured at OCI and so on, at amortized cost and so on. I'm not going into that, but if not on the face of P&L, definitely in the schedule of other income, separate disclosures of finance income is required by 107. And at times you could have a separate disclosure on the face of the P&L, may be mandated. I mean, not mandated, may be required by virtue of the materiality principles of Ind AS 1 itself. But AS, it's relatively, I would say, easier.
मैम अभी फर्स्ट क्वेश्चन में सेकंड क्वेश्चन में दोनों में ही हमारा Ind AS 1 का रेफरेंस आया है, तो आई थिंक इट्स अप्रोप्रिएट टाइम कि हम उस पर भी डिस्कशन अभी कर लें. Like the Ind AS amendment, which is applicable from financial year 23-24, which says that we need to disclose material accounting policy instead of the significant accounting policies. So whether the company can continue to disclose the significant accounting policies, or it need to delete the standard matters from the policies? Or you can also elaborate on what are the top 3 difference between the significant accounting policy and the material accounting policy.
I'm just trying to see if I can pull out some slides or like this. So give me a minute. But in the meantime, I'll just quickly take you through the concept. See, one is there are no 3 differences. It's not like a difference like that. Okay. And I think I did highlight even in the previous call that it is not just a change in terminology that you move from from significant to material. Yes, there is, but it is not just limited to a change in terminology. Now, the reason I'm going to take 5 minutes if it's okay, Asha, because this is an important one.
Sure.
Now, there is, of course, the reason this came up is because the regulators realized that the term significant is not defined in any standard. So yes, users understand, preparers understand what is material. So that was one, because otherwise, how do you really distinguish the two? Having said that, they have also given further guidance in terms of what is material. Okay, so I'll just read out some aspects of it. Some bit of it is something that we normally do, wherein we say when you're looking at materiality, you look at whether you look at qualitative and quantitative aspects both. So usually something which is immaterial in amount would usually we'll not consider that to be material, but at times due to qualitative aspect of it, it can be. So you look at both, while the presumption is you start with the quantitative and then you add the qualitative aspect. Then it gives you certain other indicators as to what can make a policy material. So they say, let's say you've had a change in accounting policy. That makes it material. Or let's say that there was no stated accounting principle given in the standards, but you used in India, so you used the India's hierarchy to form a policy. So let's say if somebody says there is lack of guidance, I'm going to India say it, I will use this hierarchy and then frame a policy. That can be a situation where they're saying it is deemed to be material. The third could be, let's say that, let's say if I take PP, I can do cost or revalued. How would my reader get to know? So they're saying wherever there are options available and you've exercised an option, that exercise of option is a material part. So you disclose those. So they've given 5, like I said, change in policy. These are illustrative. Change in policy, exercise of option, use of hierarchy, or let's say simply put, the transaction itself is so complex that without the policy, a reader may not understand. So they're saying these are some of the areas where we believe this would meet the materiality, the definition of material accounting policy, and you should disclose it. Having said that, one is, like I said, the terminology. The other big change they're saying is that what do you disclose as part of this? What do you really disclose? Give me 1 second. So what do you really disclose as part of the accounting policy? That is where they have said, give me 1 second. Can you give me presentation, right? It will be easier for people if I can.
You can share screen also. You must be getting an option to share screen.
Yeah, I can. I think it keeps, yeah. If you can see the screen.
Yes, we can see your screen, or you can.
Okay, so
basically,
yes. It gives you some guiding principles like accounting policy related to immaterial is by, typically we will presume if the transaction is immaterial, then obviously it is immaterial. However, the next sentence, as it says, please look at qualitative. So first you start with quantitative, then you look at qualitative. And they've also actually said, if you look at if we can look at this, the second last bullet, sorry. If an entity discloses immaterial accounting policy information, such information should not obscure material accounting policy information. Now, what are they really saying? They are saying, is there any bar? Are we stopping you from disclosing immaterial? The answer is no. But they're saying it shouldn't happen that you have done so much of immaterial disclosure that the material one gets obscured. Obscured means it gets hidden. So they are saying that even if you do include additional, structure your disclosures in such a way that the immaterial is later. Your first disclosures, if I have to, let's say, if I intend to give 10 policies, 8 are material, 2 are immaterial, first give the top 8 should be the material ones. So your sequencing also matters. It shouldn't be that you dump so much of information that the material one is obscure. The second bit, like I said, is having said that you've identified which material accounting policy, question is what to disclose in that policy. So let's say that if I look at my revenue recognition, okay, let's say revenue obviously revenue is a material line item, right? What do I disclose in the policy? Sorry, this is what I've already discussed. Okay, these are some of the instances of material. There, the standard doesn't really give you too much of guidance. Globally, there is a practice statement, materiality practice statement, which is called practice statement 2, IFRS practice statement 2. You can refer to that. There are some very good disclosures there for you to really understand. I'm going to take a very simple example. Let's say that I'm a company which I would typically when I used to give my accounting policy for impairment, I used to have 5 paragraphs. I would talk about, I look at the impairment indicators. Then I would say, okay, if there is an impairment indicator, I would calculate value in use. I will calculate net selling price. I will look at the difference, a higher of the two. Then I will adjust so and so. I will talk about goodwill. I will talk about intangible. Everybody typically, if you see, it's like a very long policy. Now, let me come to a case where the company has not had any impairment in the previous few years. It doesn't, even in the current year, you've determined there is no impairment. The company does not have goodwill. The company does not have intangible. It only has PPE. PPE is material, but there has been no impairment. Now, in such a case, what should I disclose? PPE is material, so related impairment, let's say if I believe the policy needs to be disclosed, the question is, what should I disclose in that? So if you take guidance from these 5 points, like I said, these are only examples. I would actually focus on, does it involve the 4th point, which is very important actually, does it require any significant judgment or assumption? So think about it. If I don't have a goodwill, if I don't have intangible, I don't need to write the paragraphs relating to what do I do. Goodwill is tested for impairment annually. I don't need to write all that. I can skip that. I can skip the paras on intangible asset. When I come to PPE, I would talk about maybe judgment. Where could judgment have been applied? Judgment could have been applied. Is there an impairment indicator? Okay. Let's say I applied some judgment there. Then after that, I would have applied judgments in terms of testing. My cash flows, etc. Certain assumptions could have come in. That is where probably my work would have been done. Rest, after that, if you've determined there is no impairment, then writing a policy as to how that impairment would be accounted for is irrelevant. Jab impairment hai nahi, why write about how that impairment would be accounted for? So in that example, if you would look at the practice statement is saying, from an impairment perspective, all that you need to tell the reader is the judgments that you exercised to see whether there is an impairment indicator, and what judgments did you exercise while determining your recoverable value. And they're saying that is all that is needed. So you can disclose it in various ways. You can disclose it in the policy. If you recollect Ind AS 1 has a paragraph 122, which requires separate disclosures of significant judgments and assumptions. If I have disclosed those judgments and assumptions there, then I don't need to repeat it in the policy. So you can, what I'm trying to say is that, one, you don't need all that 5 paragraphs. I may just need some limited, to the extent there is no choice in the standard. There is no complexity. I need not repeat it. And if, let's say, some part of it I have already disclosed under another note, okay, then I can even refer to that. So probably in the example I took, disclosure would be required of the judgments or assumption in impairment indicators and the recoverable value. I'll take one more example. I'm sorry I'm taking time, but because I think many people will not understand the change, I'll be very quick in the second example. let's say I'm a revenue, I'm a company which is into the business of selling handset along with data. Okay. I charge a composite amount from the user, from the buyer. Now, everybody knows in this, if I have to say, okay, I recognize revenue when control is transferred, etc., that's very basic. Again, in revenue recognition in a transaction like this, probably where judgment, etc., or where policy choice, all those things could have come in, is how do you allocate your composite consideration to these two components? Okay. So the standard, for example, gives me various methods by which I can allocate the transaction price to performance obligation. Maybe that is what I need to talk about. How did I allocate? Then judgment comes in, judgment not in the sense of the fourth bullet. The other bit which comes in is that under the standard, you can recognize revenue at a point of time or over time. So maybe I need to tell the reader, when did I recognize revenue in case of, let's say, the handset? Did I recognize it at a point of time or over time? Similarly, for the data. So the point I'm trying to make is where, let's say, under standard, I different ways of recognizing. That is where I need to tell the reader, because rest is assumed. If there is no choice, rest is assumed. That is what you would have done. The intention is to reduce or declutter the accounting policy disclosures in that sense. Now, having said that, all this theory, my experience right now, at least in the current year, is that I've not seen many changes being made. Probably this concept will take a year or so for companies to really evaluate as to how to comply with it. But I think we need to start thinking. You may still give many policies. You may still not really prune them down or whatever. But you please see, you will otherwise run the risk of regulator questioning that, by immaterial accounting policy information, you have obscured material accounting policy. So at least choose what you need to highlight. At least from a sequence perspective and so on, choose the right ones which are coming in the beginning. So look at that. Like I said, maybe it'll take a year or so before the preparers and auditors are really ready with it. I'll stop here.
Very well explained, ma'am. With the help of example, it actually becomes easy to understand. So now that already we are covering the 1 hour session. So moving fast to the next question. My question to you, sir, regarding certain penalties and demand issues, which may or may not arise in the coming years. I would restrict my word future, the coming years, I would say. In previous session also, we discussed one case study relating to that company law violation, where straight away penalty provisions were there. If there is any violation, that will be the penalty which may be levied. Now we have one more case study to discuss, and will be regarding the GST. In GST, like input tax credit is required to be reversed under various circumstances, like if any payment is not made to the supplier within 180 days, or there are other scenarios also. And that input tax is required to be reversed with interest. And as far as this interest is concerned, whether this interest required to be disclosed or required to be recognized in the financial statement, having regard to the fact that there are many writs which have been filed in the High Court by the party or by third party also, challenging these leviability in the law, whether we should recognize this or not.
So I'll answer the second question first. There are many places where, those petitions are filed in the court of law, and they challenge the act, the regulations, or various, various kind of provisions of the law. So as accountants and as auditors, if we start looking at all these future possibilities, then probably somebody has questioned the Income Tax Act also.
Yes.
Somebody has questioned the existence of GST also. So
Absolutely.
somebody is questioning. So these kind of questioning and debates in the courts of law, they'll keep on happening. You have to ensure that the financial statements, which are, I'm talking general purpose financial statement, these are giving true and fair picture or not. Now, in order to reach at the financial results, which are providing true and fair picture of the performance of the company in case of P&L and of assets and liabilities of the company. We are talking company, it can be unit, it can be partnership, it can be proprietorship, whether they are giving the financial position of the company or the unit. So in order to reach a true and fair picture, we will have to understand that accounting has to be done if the amount is determinable, then of the same amount, or in case required, then probably the estimates are required to be done. So your expected credit loss, your provisioning for bad debts, your provisioning for interest, your provisioning for various items, they will involve a kind of a judgment on the estimation. Estimation has to be done by the management, and auditors will test that judgment or the estimation because they are going to impact the bottom line or the profitability of that entity. So now the auditors, when they will look at, so both the situations we can take. A, the situation where the provision has been made, and B, the situation where provision has not been made. Auditor has to use professional skepticism and ask questions from both the sides. So if you have made the provisions, why have you made the provisions? What do you think compelled you to make a provision? What are the arguments in favor of it? And why do you feel the provision should have been made? And if there are no provisions made, then again auditors will ask this question, applying the professional skepticism. Why you are not making the provision? Why are you not estimating how much will be the the liability and how much should be the expense of the year? And then once you put those questions and when you get those answers from the management, then you take a decision as an auditor that in your opinion, this provision which the company or the entity has made, it is reasonable, it is to your satisfaction, to your opinion as auditors. This is actually, it is fair to make that kind of provision. It depends on various circumstances. There can be situations, there can be various underlying, circumstances or situations or point of discussions, which will compel the company to make those provisions or not to make those provisions. So auditors will take into account all those situations, will document that because your standards on auditing ask you to keep a documentation, audit documentation. So your work paper should demonstrate that you had questioned it and you have got enough answers to form an opinion that whatever the view the company has taken, whether it is prudent according to your opinion, and you have applied your professional skepticism into the whole thing.
Clarify it further. Are there any circumstances under which it can be classified, it can be disclosed as a contingent liability?
There is always a possibility. It can be a liability, there can be a contingent liability, or you can just ignore. All kind of, so you have to take into account. That is why I told you that as an auditor, whatever views the company has taken, you have to understand those views and then apply your judgment whether, in your opinion, those entries, those estimation or those provisions, they are appropriate or not.
Right. Agree, sir. And my next question will be from you, Archana ma'am. Sometimes we observe that in financial statements of certain entities, some of the items of income or expenses are shown in the statement of profit and loss under the head appropriations, or we can say below the line. For example, like provision of earlier year taxation or write back of debts and sales tax dues or other tax dues. So whether this is correct? or like showing it under the head appropriation or below the line, whether this disclosure is correct?
So the simple answer is that the only thing, according to me, that can go in appropriation is dividend. So I'll let Praveen also add to that. I don't think anything else can go into appropriation. Having said that, I think probably what the person who asked this question wanted was not necessarily just an appropriation, but also at times we have two profits, profit before exceptional, like we call it, and profit after exceptional. And that also is sometimes very loosely referred to as below the line. Okay. I do not know if that was the question. Now, if that was the question, that's different from appropriation. So let's say if I have an exceptional item, and the word term exceptional item is not used in the standard, that's what we normally use as for something which is unusual, non-recurring, and so on. There's no hard and fast rule as to what constitutes an exceptional item. It is a judgment. And my request would be not to use it very liberally, because then it just distorts the profit calculation. So let's say that I have, and I think we discussed this last time also. I think we did discuss exceptional item a bit, wherein I said you look at it, whether it has predictive value and so on. So I'm not going to repeat all that. Some of the participants may be new, but I think be very careful. If you feel this is non-recurring, it will take away comparability, it does not have any predictive value for the future, then you can show it as an exceptional item, right? But what is exceptional can differ, depending on facts and circumstances. It could be that something, foreign exchange fluctuation, which was exceptional in a particular period, the way the currency movements happen, after a point, it may happen that, okay, initially I may think, oh, even 5% change is very significant. It could be that the way things move, something may become normal and so on. So you also have to look at it in the context of, the facts of the case, and the judgments can differ over time depending upon what becomes normal. Okay, something which is abnormal in a particular period, let's say over a period of 5-7 years, may become normal later and so on. So always exercise that bit. Similarly, it can differ from geography. For example, it could be a place now, for example, I remember initially when Chennai had their floods, we thought it's exceptional, but with the way Chennai keeps on having flood, I do not know whether it's exceptional anymore. So you also need to see, is something that infrequent, right? And then give it. So I would exercise due care to see whether something is exceptional. Definitely none of the items that you said are appropriation. And as far as the write back of taxes, etc. is concerned, of course, taxes, you have profit before taxes and then taxes. So yes, if I've got any adjustment, additional tax for previous year or any reversal, that I can show in the line items where the tax is being disclosed. So that can happen.
But this tax which I asked is other than the income tax. Like sales tax.
I think you said write back of tax. I thought you said write back. I thought maybe at times that you
write back of debts and the taxes, sales tax, like.
So okay, if it's sales tax, etc., it's a different thing. But if it's an income tax, then I'm just saying I can adjust it where the income tax line item is. But write back of debts, etc., if it's happening in the ordinary course, these are not exceptional items. So I'm just trying to say, please, everything take into account in your PBT. To the extent, I'm presuming these items don't relate to income tax. Anything which doesn't relate to income tax, please take to your PBT. If it is exceptional, like I said, judgment to be applied, you can determine two profits, profit before exceptional and profit after exceptional, but none of the items meet the appropriation criteria. Do you want to add anything, Praveenji? I think appropriation is very simply the way I thought was only dividend.
Yeah, but I think primarily, like you said, it should not be used very liberally. And there is always a difference between extraordinary and exceptional. Those are very interesting questions for the examination hall. What is the difference between extraordinary and exceptional items?
I don't think that is anything. Yeah.
So we need to be extra careful before getting into this exceptional orbit.
And if I may add, if somebody does disclose exceptional personally, then the question of EPS comes up. So typically you will see there is, if I recollect, educational material, even in AS, I'm not talking about Ind AS, even in AS, they usually say you should show an EPS on before exceptional and after, show both then. So there can be many other implications to be taken care of.
Moving forward to our next question from you, Praveen sir. This is regarding Ind AS 12, or we can say AS 22 under AS framework. What procedures are to be followed to accurately calculate and disclose income tax provisions in the finalization of financial statement under Ind AS 12?
So, deferred tax you're talking about.
Yes.
So there was a lot of debate when this concept came to India, and we were all wondering, like I mentioned earlier also, that what is this tax all, what is this entry all about when there is no, so what is deferred tax and what is deferred tax asset and what is deferred tax liability? And then people started understanding, and now I think more or less the concept is understood by people. But the calculations, whether it has to be done on the balance sheet based or the P&L based, that is still not very clear. But when you implement or apply Ind AS, so we have to go on balance sheet based calculations. So there is always a debate or discussion around deferred tax calculations. The companies which are doing or the entities which are making those calculations and the auditors who are looking into those calculations. And there are various assumptions. Like, for example, in case you want to have deferred tax asset, then you will have to have underlying, profitability coming on your way there. You need to have a reasonable assurance and all that kind of stuff. So the procedures for calculating deferred tax assets and deferred tax liabilities, they have been very detailed and very uh, very clearly, there's a lot of guidance which has been given in the accounting standards. But from auditor's perspective, I must say that look at this deferred tax creation of deferred tax asset more closely and very carefully, because this is one area where even the regulators are asking a lot of questions, and even the companies, they, in the enthusiasm of showing a good picture, healthy picture, they may create assets which is deferred tax asset, whereas in the standards they might not be, they might be questionable. So you need to understand that the accounting standards give a very detailed guidance, but as an auditor, you need to be extra careful. You need to be, again, I'm saying the same thing, repeating. You need to apply your professional skepticism, because this is one area which is quite subjective. And the questions can be very tricky also. Like in one year, the tax rate is particular. In the next year, the rate is changing, or there is a provision of MAT. Then there is a provision of reversal of MAT. Then there is a provision of some benefits which are being given to any entity for under a particular section of the income tax. Then after a few years, that company becomes ineligible to get that kind of benefits. So all these things have to be taken into consideration, and your audit work papers should demonstrate that you have not left out any question which you need to ask in order to understand how the management has done that calculation and how that calculation is appearing in the financial statements, and whether the disclosures have been properly done or not. So this is one area which is very critical. And it's a matter of, because this contains calculations which will involve various factors, like, I had mentioned, and there is a subjectivity which is involved. And then there is a reasonable assurance of earning profits in the future, which will take care of those taxes which we have, parked it as a deferred tax. So one need to be careful. And then there are so Asha, there are, I think, some questions also in the chat box. Would you like to
I
take?
think, sir, we can take it after the complete
If
after
the,
complete our questions.
if the time permits, right?
If
Okay,
time will definitely, we will keep last 15 minutes for today's questions which we
right,
have received online.
correct,
So, sir, in this which we were discussing just before regarding this AS22, if we take an example of a startup company, like they get a tax holiday kind of the tax exemption for certain 10 years of period, or may say like 5 years or something,
right.
whether deferred tax assets or liabilities need to be created for that period or after that period, if you can explain it with some examples.
So basically, if you look at the basic concept, I will speak on concept only.
Yes.
That uh, basically it is kind of, if you have paid tax and then there is a um, there is a delay in recovering that tax, or there is an item which is a difference. So you are calculating, let's say, for example, in your example, which you are giving startup. So there is a possibility of getting rebate, and there may be a possibility that the startup company can stop getting that kind of rebate,
Yes.
or so this is exactly what I had mentioned, that you need to be careful and understand the underlying documentation and principles where you will need to justify how the company has done this calculation, and how, as auditors, you have looked into those areas, and what kind of work papers you have created.
Right, sir. Archana ma'am, are you there?
Yes, yes, sorry. Yeah.
Yeah. So, because my next question is from you only. If we talk about Ind AS 115, which is revenue from contracts with customers, so can a company recognize revenue if there is a correspondence with a regular customer, but actual goods movement is not there up to 31st of March? Also, can we recognize the revenue on accrual or actual billing basis?
So you're not going to like me at all because my answers are very long. But I feel this
Try
is a
to
very
keep it short.
important question. This is a very important question.
Yes.
I think especially at the year end. Okay. And see, I'm sorry, I'm just going to give a little bit of background. Why is revenue recognition? One of the reasons revenue recognition is so critical is because quite often it is linked to, various metrics, performance metrics of the company itself and the senior management. And therefore, there can be pressure on the management to kind of overstate that, in order to demonstrate that they've met the targets. So you need to be very careful, especially at the cutoff time. And that is why we, as auditors, we look at the revenue cutoffs and so on. Two or three things, the kind of examples you took, I would be very careful at year end when looking at revenue recognition. So just mere invoicing date, all those things, they don't really justify revenue recognition. If I look at, there's a slight, I think the broad concept is the same between AS and Ind AS. I mean, when I say broad, of course, there is Ind AS is more detailing. It has more detailed requirements in terms of that concept. AS9 is based on transfer of risk and rewards. Ind AS is based on transfer of control, wherein risk and rewards is one of the indicators. But I think still there is a lot of similarity in terms of the timing, in some of the context, in terms of transfer of control or transfer of risk and rewards. Now, let me take a very classic case wherein we say as auditors, we need to be very careful, is bill and hold. Or the other term which is also quite often used or seen is called channel stuffing. Now, what happens is if I have to meet my targets, what I will do is I have my dealer, I will push down sales, even though the person doesn't need it, I will push down and the material will get accumulated at the dealer level. So I would show as if I have made, but in the whole chain, supply chain, what I've done is I've pushed the inventory from my level to the next level, right? Even though that may not have been required, there may not have been any genuine case for the dealer to buy goods from me, but given my ability to negotiate, I have pushed those sales. Okay. And the other is, like I said, the bill and hold. The bill and hold, what happens is you don't even push down the inventory. You kind of incentivize your customers to place orders, right? And the inventory stays with you. Now, we need to really see whether in these cases the risk and rewards have been really transferred, or in the context of Ind AS 115, whether control has been really transferred. So I'm taking a very simple case of bill and hold. So let's say if I can demonstrate that I have incentivized my dealer to place an order. I have said, if you will place an order, I will give you X% discount. I will also keep your goods free of storage charges and all those things. I will also take the expense relating to insurance. That should set off a trigger, right? Now you may say, listen, this is a commercial arrangement between the two. Okay, why are you so concerned? I mean, why is it not revenue? The point is that in an arm's length transaction, why would I bear insurance and storage of an inventory which is not mine? So that actually goes to show that the dealer didn't really need it, or the customer didn't really need it. You are just saying, okay, listen, you will really have to do nothing. I'm just creating a paper invoice. The goods stay with me, the insurance risk stays with me, the storage cost is being borne by me. I'm giving you an incentive to even book that order. That should actually trigger. And I'm not saying these are all necessarily bill and hold. I'm saying this is an indicator. And I would be very wary of recognizing revenue on accounts like this. There are other conditions also, whether the inventory is segregated, can you mix it? So if it's a genuine bill and hold, then I will actually keep the inventory aside. If it is for customer X, it is marked for customer X. I cannot use it to fulfill the order for customer Y. There is specific identification and so on. So there are many tests to be met before you can really recognize an item or revenue relating to a bill and hold transaction. So be very careful. I think when I come to year end, I would be very careful on bill and hold. The other is that, where inventory is in transit. Okay. Quite often I've seen this term being used, or this is CIF or FOB. I will therefore recognize some rule-based is followed, that because my invoicing terms are X, it means if I've dispatched, I can recognize. I wouldn't go by any such rules. I would actually look at who in substance has risk and rewards while the goods are in transit. So give you a very simple example. Let's say you are my preferred customer, you're a priority, not a preferred, priority customer. You're in some other state. So you tell me, Archana, can you please ship goods, right? You purchase goods from me. And I also say, listen, I will arrange the shipping for you. So I will find a shipping company who will kind of deliver. Now the question is that, the shipping entity, is it your agent or is it my agent? Okay. There can be, these are all commercial terms. I may say, listen, I'm only identifying, Asha, you please pay the person. It's your agent. My job was only to help you find a shipping party. The other is to say that I will provide you shipping services. So I will charge you separately for shipping, and I will also make a margin in that. So there could be two performance obligations, sale of goods and shipping service. The third could be that while I have offered to do this for you, right, I have also retained the risk and rewards during transit. If anything happens to the goods in transit, it is still my loss. And in that case, I would say, it doesn't matter CIF, FOB, whatever, you should not recognize revenue. Quite often I hear, people saying, no, listen, I'm going to recover the freight from them. Therefore, that means risk has passed. No, nobody gives you anything for free. If I'm arranging the shipping, I would obviously recover it, right? Just because I'm recovering doesn't mean I've transferred the risk. Also see, I don't get too influenced by, I'm not saying you disregard it, but I wouldn't get over influenced by in whose name is the insurance policy. Okay. Now it could be that insurance policy is in my name, but you could be actually the insured party, in the sense I may have undertaken that if something happens, I'll, manage the paperwork with the insurance company, but any loss will be yours. So you need to see, irrespective of who the insured name is, who is really going to bear the risk and rewards. So quite often people say, oh, I don't know, I've not had a loss in transit, so we don't have past precedent. If you don't have past precedent, look at the legal terms. who will really bear the loss? Let's say if the loss happens of 100 and the insurance company reimburses only 90, who will land up bearing the loss of 10? Irrespective of what the invoicing terms are, what these are all commercial terms, more for at times for administrative convenience, may not necessarily be representative of transfer of risk and rewards. So at year end, please be very careful when goods are in transit and revenue is being recognized. Be very, very careful there. Bill and hold, for example, be very, very careful there. This I'm talking about sale of goods. Rendering of services has its own implications. Construction contracts will have their own challenges in terms of how do you measure work completed as at that date. So those are some of the considerations. Like I said, I can go on for another 20 minutes on this. But if I was to go back to your question on invoicing, just invoice is not good enough. And what did you say was the other thing?
Approval thing.
Sorry?
Only customer correspondence with the...
Yeah, just a customer correspondence, or there is actual
no actual
has not happened. You don't know what do you mean by revenue on accrual. I mean, revenue is always, obviously, you do on accrual basis. But when has it accrued is the big issue.
Yes.
Okay. So movement has not happened. Even then it can be revenue. Movement has not happened. It may not be revenue. Please look at if the goods are with me. Is it a genuine? I mean, if the question was raised in the context of no good movement, which means it's a bill and hold, I would be very careful on bill and hold, especially during the near the year end, to see whether the terms are arm's length and whether these are separately identified. Is it all those indicators? The standard has these. The standard has these guidance.
So I want to add on to this.
Yes,
there's another dimension. And I'll explain that dimension with the help of another example. So let's say there's a company which is, and the managing director, like you mentioned, is under tremendous pressure to show the results. So they are manufacturing certain items, and this person is about to complete that production. But in order to, in the enthusiasm of showing it sale of the current year, he calls up the customer. He says that, boss, your goods is ready, but I'm not able to dispatch it today. Maybe it will take 2 more days, but I'll do it. But I'm going to raise an invoice today, which is 30th or 31st of March. Can you please make a payment to me today itself, so that I'll be able to demonstrate to the auditors that the bill was raised and the amount had come, and I'm going to recognize that as a revenue of the year. So, and customers also will, or the dealer also complies with the whole thing. And this person shows it as a revenue of the year. And later on, and this is another dimension, it was treated as a fraud related to higher revenue by that managing director. And there was a the case against it because that person was showing higher revenue. There was a revenue recognition fraud, and the auditors were also made answerable for that kind of situation. So it's not as simple as recognizing or not recognizing. If you're auditor, and if you are not looking at the things the way Archana has explained, I think there's a dimension of reporting fraud also. And please remember, Asha, that revenue recognition fraud is something which is one of the largest across the globe in terms of number of instances. And also, whenever we do audit and whenever we recognize risk, the fraud risk in revenue is one of the most common identification of the fraud risk, revenue recognition. So this is very, very critical, very important. So I just wanted to add on to this by, putting this dimension of reporting of fraud also.
So thank you so much. I think I wanted to add that in the beginning, the point that Mr. Praveen made in the end. Whenever I think, why is revenue recognition so important? Because like he said, if you look at the past, revenue is most susceptible to fraud. And my understanding is that the presumed risk of the revenue is an area where there is a presumed risk of fraud. Okay, so that is why, and especially during near the year end, I would be very careful. doesn't matter invoice, doesn't matter money. I would look at who has the risk and rewards in AS and whether control transfer. And sorry, I know Asha would not. I'm going to take 1 minute because please, this is it. This is important. Like he just said, this is one way.
Yeah,
Bill and
we
hold is
left with
another
less
channel.
than half an hour and many questions are still
They
pending
have
to be
This is
answered.
very important.
We'll
This
cover,
is
don't worry.
Yes, yes,
So
absolutely.
the other
Please
is,
go
I'll
ahead.
tell you, there are many ways this happens. Okay. Now I actually in the discussion I've got the points gone, but there are many which ways in which I actually wanted to take two more examples now. I'm just missed. So if I remember, I'll come back. I think no, Asha, this is very serious because, like I said, revenue recognition is most susceptible. People need to recognize various ways in which can happen. In AS9, for example, India is still more stronger. I'll give you a very simple example wherein while AS9 is intended well, substance over form, but it is not written very strongly, and that is why India has sought to kind of strengthen it. Now, let me give an example. What I do is I have to sell goods to a customer. My customer says, listen, I want delivery within 1 day. By the time I need it, my thing should not get held up, and the product I sell is more like a input to their production process, right? So what I do is I keep I kind of say, okay, I keep an inventory at the customer's location so that I can meet that requirement at any point of time. So what happens is I cut an invoice, I issue an invoice, I so-called show amount transferred, right? The goods transferred. The goods are physically lying at the customer's premises, but they are actually under my control there. If something happens to it, it's my. So typically you will say, oh, invoice has been issued. The goods are lying at the customer, this thing. But actually it was only done to make sure that you're able to meet the requirement at a short notice. The inventory risk was totally with you. Okay. No risk and reward had been transferred. If something happened to the inventory, that was your loss. If movement happened in the price of goods, that was up to you. And all those things, obsolescence, whatever you call it. You need to be that careful. I'm just saying, there is a group which feels, oh, no, legal sale has happened. In law, because I have issued an invoice. In law, I have held out under GST under this. How can you tell me there is no sale? Legal sale has happened under Sale of Goods Act. So therefore, I will recognize. Be very careful on stuff like this.
Absolutely.
Sorry, you will proceed.
Moving on to next question, sir. How are the measurement principles of non-current assets held for sale in accordance with Ind AS 101 is being addressed during the finalization of financial statement? If you can help with example, that will be more easy to understand, I guess.
Yeah. So one is that it is 105, which gives you guidance on non-current asset held for sale. And this is something which is, a very, very important part. You have to identify that unit or that asset which has been held for sale. So there can be various situations, and there are conditions which are given in 105 when you can treat that non-current asset as held for sale. So it is a decision of the company, the board of directors, and it is expected that sale will happen within next 1 year itself. So, and then once it is identified as non-current asset held for sale, then you will have to do accounting, which is of a different kind. So you will treat it separately. You will park it separately in the balance sheet, and you will park it separately, the profit of that or loss of that unit separately into P&L, because it is held for sale. So there can be, so if a company is having, let's say, 7-8 different units, and one unit they have identified that, okay, we are going to sell it out, and they have passed in the board, and they are, they know that this is the value which is expected, and it is expected that this will be sold within next 1 year itself. So you have to value it as expected sale price minus cost to sell, versus fair value, whichever is less. And then you will stop charging depreciation on that, because this is something which is a concept in Ind AS. And there's a very detailed guidance which is given in Ind AS 105. It is like IFRS 5, which gives you guidance. And this is something which is very interesting, because when you read those standards, when you read IFRS and when you read Ind AS, at a conceptual level, the way IFRS standards are made, in case there are dissent opinions, those dissent opinions of the members who are in the board sitting and passing that standard, they are published along with the standard itself. So in India, we do not have that kind of situation, because it is taken as unanimous. But in other countries, so in case of IFRS 5, if I remember correctly, there were two dissent opinions. So one person said that when we are making this principle, it is looking like a rule, but IFRS is like more of a substance based. So how can you make this kind of a rule? And second person said that there's a, how can you have an asset you will not charge the depreciation? This is basic principles of accounting for fixed assets. So these are, so some dissent opinions were there for this IFRS 5, which became Ind AS 105. But in India, we do not have that kind of concept. But yes, you have to identify that unit or that non-current asset which is held for sale, and then you have to account for it in a separate manner. You have to take profit or loss of that unit separately into as single item into P&L. Yeah.
Thank you, sir. Now, next question to you. So I'm moving a little bit faster. This question is regarding preparation of aging schedule for classification of trade payables and trade receivable. The main question is which date should be taken as the base date for computing that aging period, because in many cases there is no separate return agreement or something other than that invoice. So what should be taken as the base date?
This one I'll be very quick. This is there in the guidance note. You go to ICA guidance note on schedule 3. There's very good guidance available that aging you typically take from due date. But if the terms are not, if there is nothing in terms, you've not agreed, then it is from date of transaction. That's what I recollect. It's there in the, go to the schedule 3 guidance note. It's very, very well articulated there in detail. That's a quick
and if anything is written on the invoice, like invoice date is of 1st of March, and anything written on like any dispute to be raised within the 7 days, or payment should be made within the 7 days. So can that be taken into account?
See, one is if it says there is a due date, 7 days, then it's a due date, right? So then I will take it from the due date. If there is no due date, then the other bit that you mentioned, that's where the smaller bits come in. You said if you have any dispute. Now I will need to think about that one. Okay, because does it mean that it is subject to certain acceptance criteria? I have a right to reject. If I have a right to reject, and if it meets your requirements, only then the sale is deemed to happen.
Sorry, ma'am, your voice break in between. Can you please repeat?
I'm just saying that the second bit that you said was easier. The first bit, when you said you have 7 days to raise a dispute, will raise more questions. I will need to see, does it impact my revenue recognition timing? So for example, if I send goods and the goods are subject to acceptance in a way, right? You will check the quality or whatever it is, and you have a right to reject, right? Then the sale doesn't happen unless and until I can demonstrate this is so routine. I can demonstrate 99% this is met. It is not customized. So it depends upon, you'll have to go back and see what the dispute permission terms are. What can the dispute be raised for? Is it for just the amount, or is it even for acceptance of the goods? Then it may also impact your revenue recognition date itself. So that's just as a caveat.
Got it. Praveen sir, next question from you regarding consolidation of financial statement. The question is, while consolidation, is it enough for a company to mention that most of the accounting policies of the reporting company are same and in line with the IGAP? But since some subsidiary are in different business line and functioning in different regulatory environment, Some of the policies with respect to like investment, gratuity, depreciation, etc. are different. Just mentioning this thing is enough, or something else need to be disclosed?
So when you apply the standards, you have to read the standards carefully. You cannot say that we have applied the standard, but clause this, and this of the standard we have not applied. It cannot happen like this. So you have to understand that when you are doing a consolidation, Ind AS 110 gives you very clear guidance that in case the policies, accounting policies, and the methods, they are different in your subsidiaries, you will need to make adjustments in order to bring them in line with the policies of the consolidating entity or the parent entity, and then you will need to do a consolidation. Although there is a time gap also which is given, which is allowed, but then you'll have to draw basically bring in the adjustments which are required. So you have to align your policies according to the policies of the consolidating entity. So it is not it's not allowed to have that, okay, component has not aligned policies related to investments, valuation, and all those kind of stuff, but otherwise they are in line, so they have done the consolidation. So you have to apply the principle in totality. So if it is 110, you have to see the standard and then apply it. So you have to do the adjustments.
Okay,
it is
sir.
required by the standard.
Moving forward to the government grants, my next question is from you, Archana ma'am. How should the companies account for the government grant received against specific schemes like EPCG scheme for import of spare parts and all? And what disclosures are required in the financial statement?
Okay. So disclosure, there would be a proper list. I'll be honest, I don't remember offhand. I would request, but it will be typically about the amount, nature, and policy, etc. But I'd like to take a few minutes on accounting for government grants. Okay, and there is a big difference between AS and Ind AS. There are significant differences here, which I think, if you'll permit me, I think they need to be appreciated. So one is, if I look at AS, you have grants which are in the nature of promoters' contribution. Then you have grants which are related to assets, and then you have other grants, okay, which are related to revenue. Grants in the nature of promoter contribution, frankly, very quickly, are very few. I haven't seen them in the recent past. It is like saying, whosoever is the government, if they're giving you the grant, is acting more like a promoter, and which means that usually it is given with respect to a particular investment that you make. So they're encouraging you to make an investment, and they're putting in money. There are no other conditions involved other than making that investment. But usually I've not seen this happening in the recent this thing. Most of the grants are subject to many, many more operational conditions. Now, let me take, now there could be grants. I think you've raised the issue of EPCG, which I understand is that if I export some goods,
capital goods.
Yeah. So if I export some goods, I get some grant which I can then use later or whatever. Now, I think at least in India, the ITFG has given some open-ended. They've kind of left it a little open to judgment. So therefore, just going back to what Praveen said, these are just my views. When I look at EPCG, whether under AS or Ind AS, I would actually, when it comes to whether an asset is for whether a grant is for an asset, my key condition would be, do I need to do anything other than acquire that asset? Okay. If there is anything else to be done, then I would actually not take it as an asset-related grant. Now, you may argue, where is it very clearly worded? There's a lot of interpretation issues involved. The way I see is, at least when you look at AS 12, it uses the term the principal condition or something like this. So yes, you could have multiple conditions in a government grant, but you look at the principal condition. If I would not get anything till the time I have, imported or export, that have done that asset-related activity, I would not take it to be. So the test for meeting something an asset-related grant, according to you, is much higher, and then rest is revenue. Now, promoter-related grant in AS goes to reserves, because that's more like a capital contribution. Okay, so it goes into capital reserve. Asset-related grant, you can offset from the asset, or you can show gross, and then you can take it through P&L. If you're showing gross, it'll go through P&L through depreciation. The other, which is revenue related grant, you obviously take it to P&L. So that's the whole this thing. So like I said, please be very careful. Quite often, if I look at the schemes which are in vogue, the most of the schemes, the way they work is that apart from setting up a factory in a particular location and making a particular level of investment, the grants don't come to you in the form of cash. They come to you in the form of refund of GST. They come to you in the form of electricity cess waivers. They come more in the form of waivers and refunds. So the fact that just because I've set up the plant there on its own doesn't entitle me to the grant. I need to do other activities as well, and that links it to my operating activities. So I would, for example, as a person, would not take them to be an asset-related grant, but there are different views there as well. When you come to Ind AS, very quickly, you don't have 3 types of grants. There is nothing called promoter-related grant in Ind AS. You either have an asset-related or you have a revenue grant, and everything goes through P&L sooner or later. Even if it's an asset-related grant, it'll go through P&L. So because there's nothing called promoters contribution grant or grant in the nature of promoters contribution was the only one that went to capital reserve. You have nothing like that. So all grants will sooner or later go through P&L in Ind AS. The big difference I want to highlight here is that in AS, if you got a waiver of an expense, that was not a grant. So the example I took, electricity cess waiver, okay? Or if I said you will not have to pay X tax, that was not considered to be a grant and no accounting was done. But under Ind AS, whether you get cash or you get a waiver, it is a government grant, and it makes a huge difference. And I'll tell you why. Because in AS, let's say, if I had said waiver is also a grant, then all your tax holidays would have fallen into grants. They're all waivers in a way. You're getting a deduction, non-cash. So because the standard did not have an exemption for tax holiday, those were not considered to be. It kind of worked very beautifully like that. When you come to Ind AS, because waiver is this thing considered to be a grant, there is a scope exemption they've added that tax holidays, etc., would not be grant. So, but if I have an electricity cess waiver, like I said, I will need to account for it as a grant under Ind AS. So there is a big difference between the two. I think these are some differences I just wanted to quickly highlight apart from the EPCG one. So EPCG, I think if you look at the ITFG from an Ind AS, they have said the company should exercise the judgment. Is it related to revenue condition or is it related to an asset condition? And then you do either. My sense is that I think this is related to an asset. Yeah.
Right, ma'am. Going forward, my next question will be from you, Praveen sir. This will be regarding Ind AS 34, Interim Financial Reporting. So question is, what are the significant events or transactions that must be disclosed or account for in the interim financial reporting as per the Ind AS 34?
So this is Ind AS 34, clause 5. Final content of an interim financial report. This is something which one should refer to, and this is very, very basic. There is no opinion required on this. So basically, the only point which I want to make is that interim financial statements are made when a regulator asks a company or an entity to make those interim financial statements. It's not the standards says when you need to make these interim financial statements. Standards will give you what is required to be given there, and it's very, very simple. You have to just go through the standard, and I'll not waste a lot of time on reading those lines and telling you what is all required in those lines.
Sorry, Asha, can I? Sorry.
Yes,
can I just,
yes, ma'am.
Sorry, not on this one, on the other. Sorry, I think while concluding, I didn't say it correctly. EPCG, sorry, I said it, for me, it is, I take it like a revenue grant, not, because I was also talking about the ITFG has left it open. If you look at the EPCG grant, it says you can import an asset without import duty if you have done the export. So the primary condition is export. Till the time I don't do the export, I don't get entitled to it. So for me, the primary condition is export and I will take it revenue. There are people who say, because I'm going to use it to offset import duty, that is why this import duty for an asset. That is why they link it to an asset related grant. So for me, I just wanted to clarify, my personal view is it's a revenue related grant.
Okay. Next question is from you, ma'am.
Yeah.
This will be regarding prior period items. Sometimes what we have seen is that prior period expenses and incomes are included in the respective head of that expense or income in the P&L account. So is it the correct so far as AS5 and corresponding Ind AS is concerned?
Okay. So again, here there is a very conceptual difference in how errors are accounted for in AS and Ind AS. So first, let's take AS. If you've got an error, you have to correct it in the current year. You cannot restate your previous year as far as AS is concerned. And then let's say if it is a material error, and I'm presuming it's a material error, otherwise we're not talking. There are 2 or 3 ways the standard permits you to disclose. So let's say if it's an error relating to my employee expenses, right? So I have now, my previous year, there was something, I did not accrue, I had under accrued, let's say. Okay, so my expense was under accrued, and therefore the incremental expense I have to recognize, I'm recognizing it in the current year. I cannot restate previous. So my current year employee expense will include that amount relating to the previous year also, which I did not recognize. I can highlight it in 2 or 3 ways. I can actually include it there, and I can just against employee expenses, just say refer note so and so. And the note can then explain that, let's say if my employee expenses are 10 crores, I can say this includes X rupees relating to previous year or whatever, and explain the error there. The second is I can put the amount in the brackets itself. I can say employee expense brackets, including prior period expense of so much. Okay. The third is that just like we discussed that exceptional item, because in a way an error is supposed to be, you can consider it to be an exception. You can then show the correction there. And then so there are 2 or 3 ways you can do it in terms of you can include it in the same line item, but the reader should know how much of it includes, because otherwise comparability gets vitiated. How do I, because my current year expense also has an expense relating to previous year. So for comparability, I need to call out that. I don't need to necessarily have a separate line item. I can do it in the brackets. I can put it in a note, refer to that note. That linkage should be very clear that whenever someone is reading, let's say if it's an employee expense issue, the linkage should be very clear that the person reads my current year amount together with that note, or either it's there in the bracket. Now, this is where the amount was not accrued correctly. The other bit which I want to take, which is very commonly seen, what if it's a reclassification issue? It is not an issue that I did not accrue. It was sitting in the wrong line item. So therefore, there is nothing to be corrected in the current year. Okay, it was accrued. My profit or loss is right. Just that my line item in which the expense was sitting was not right. Now in AS, I'll be very careful. I wouldn't touch the previous year number because we don't have the concept of restatement. Very often, you see a very simple note coming in financial statements that items have been, previous year numbers have been regrouped, reclassified, wherever it is. You can't do that. That is tantamounting to restatement. Now, does it mean if I made a mistake, I should keep quiet? No. What you should do is, let's say there is an interchange between my, I'm just thinking of any 2 items of expenses, right? And I need to basically just move one from the other. I should have a note against those line items. In the note, I should explain, this is the number which I disclosed. What is the correct number? So you give pro forma disclosure, as I would call it. There was an earlier SS 710, which actually the revised SS 710 is not so explicit. The previous, the pre-revised SS 710 actually had a good reference to this. So you could do this through pro forma. I would do it through pro forma, because otherwise there is very open, you don't only get to know where the changes are. It is used very loosely. And the regulators, what happens is the regulators, when they do a review, okay, they will pick up your previous number, compare it to the last year audited numbers, and they will say, listen, this is not tying up, and you will end up getting notices. So no point. Do it in the pro forma disclosures. When it comes to Ind AS, do you want me to go into Ind AS, or we leave that? Ind AS, there are very specific.
I think it is important.
Comparison is required.
So I'll very quickly, in Ind AS, errors are, if there is an error, you restate your comparative. Okay, so you will actually, whether it's a accrual or whether it is a reclassification, you would correct that. And of course, again, I'm presuming you would do it for material items. Recently, I was asked, what if the item is not material? Okay, it's an error, it is not material. Can I then take it in the current year? No. The only reason the standard is referring to material error is to say, okay, you don't need to touch an immaterial. But if you choose to correct even an immaterial error, please still follow the standard. So there the standard says, let's say it could be an item wherein I made the error only in the previous year. Or let's say it could be an item wherein the error was continuing for 4 years. Okay. Or, it was made 3 years ago. So then the standard says if the error relates to a period which is beyond your previous year, then you correct even the earlier years in your opening balance sheet. So let's say my current year is March 24. My previous year is March 23. Okay. So opening balance sheet of March, when I would have done for 22-23, the beginning of the year was 1st April 22, right? So I will have a third balance sheet of 1st April 22, wherein I would say what the accumulated error correction would have been. So till the impact till 1st April 22 will go into the opening balance sheet. For the year 22-23, I will restate my comparative, and current year I'm presuming there is no error. Then there are very detailed guidelines that if you're giving a third balance sheet, you don't need to give all the notes relating to the third balance sheet. You will only give those relating to the error and so on. But there are very specific requirements as far as Ind AS is concerned.
The next question is, how can the company stay updated with the latest development in Ind AS and ensure the compliance with the ever-evolving standards?
Do you want to take this up, Mr. Green? I think one is, of course, like attending these webinars. But
they have to hire decent people, chartered accountants.
Very rightly said, sir.
Yeah.
So see, I think there is, on a very serious note, there is no shortcut to it. If you think you'll attend some small seminar and you'll be, the way the issues are, one is, I know it sounds again very preachy, but it's actually the transactions are becoming complex, and therefore to address complex transactions, you want more guidance as a user or as a preparer. So the regulators are issuing also more guidance. It could be ICA, it could be for, let's say, if we are converged with IFRS, so you could have IASB, FRIC, agenda decisions coming. So every regulator is doing their bit in terms of issuing guidance or looking at what needs to be corrected. So you do have to have a very concentrated effort in terms of tracking this. If let's say you're a preparer or a auditor, you could have maybe a dedicated group which monitors this and then, briefs the other. You could have a group which is focusing on this and then kind of educates the rest of them. As a professional, you yourself, I think even if you do get some download from anyone, there is no shortcut to reading the amendment. You have to read that amendment. And I think just even if you, as and when these amendments or guidances are coming, just do a quick read. You don't have to really become a master there and then in the first read. It'll just stay in your mind that something like this has come out. So when you're coming across a situation, you will know, oh, something like this was available. At least you need to refer to it. Yes. So just at least knowing that's the topics on which guidance is coming out, that itself is good enough, because there is something available and you can refer to it if the transaction is relevant to you. So I would say put aside some time, if not weekly, fortnightly, monthly, whatever. As a professional, you'll actually have to put aside, okay, this is the time I want to do for my own CPE. Not because I have to kind of meet some hours for ICI, but genuinely kind of to keep updated. That's all right. And I think do as many deliberations as possible, whichever groups. I think every deliberation, even in this questions that Asha is asking us, we've also landed up, like I said, refreshing. There's always a learning, as many discussions as you can have.
And also, just to add to it, there are publications. So some of the large firms are issuing weekly updates, monthly updates. There are updates coming, and then there are various journals which are there. If an individual or a professional is asking this question, then they need to subscribe to those updates and publications in order to read what is happening, what has happened in the previous week and what is happening, across, because there's so much which is happening. And apart from these regulators who are standard makers, There are regulators who are reviewers also, like NAFRA and PCOB, who are also, giving you updates almost on every second day. There's something or other coming, and there is some kind of understanding. Their understanding is coming out. So one need to subscribe to those, and generally most of these are non-chargeable kind of subscriptions. So just click and give your email ID, and they'll fall into your mailbox. I think it is very important. One person. So if the professional is asking this question, it's very important to keep updating. And if a company is asking this question, then one person need to be made responsible for all the updates which are happening. And there are various laws, and especially these regulators are very, very hyperactive these days, I would say.
So with this, we will now move to the questions from the live audience of today's session as well as from the previous session. So I will be asking question and expecting answers in a quick minute. So my first question will be from you, Praveen sir. What if an entity receives information of supplier being MSME after 31st March 24 and the entity has already skipped the payment on due date due to that wrong assumption that he was MSME?
So the law is very clear. There will be a penalty and there will be interest. So as an auditor, you need to understand the impact of subsequent events and also keep in mind that concept of materiality which was discussed. But no CLAR is also very, very important, non-compliance. So you need to make sure that compliances are done.
It should be disclosed as an MSME trade payable.
Absolutely.
Okay, sir. Archana ma'am, next question will be from you. After the creditors, I request you to share your views on the debtors, like what rules should we follow to write off debit balance of our vendors and debtors, or what rule we should follow to write off as a bad debts, any receivable to write off it as a bad debts.
There's no rule. I think you just have to look at recoverability. If recoverability is a challenge, see, it's impairment. It's as good as that. So if you are doubtful, see, one is we call provision for doubtful debts, and then the other is we call bad debts itself. Now, one is where you are hopeful of recovery, in the sense you make a provision, but it's not like it's very clear case of like a loss, like a very clear, there's no hope of recovery at all. So that case you make a provision, but if there is no hope at all, it's gone. Let's say your customer has gone bankrupt and you will get nothing, very clear. It may be time to write it off. Write it off is as good as saying, okay, it's like a certain loss, whereas provision is more like an expected loss. I think in terms of rules, in India, of course, you've got ECL, right? So there is an ECL provisioning model, etc. I don't think we can summarize that in 1 minute, but that's all I would say. I think it's all about recognizing an expected. In AS, you are doing an incurred loss model. That is what we say, wherein when losses happen, when the debt has actually it started, your recovery is low, or not expected to happen, then you start. Whereas in India, even if the asset is good, right? You start making a provision for it because no asset becomes bad immediately. So it moves. Every asset was initially a good asset and then it moves. So that's the difference. Incurred loss as far as AS is concerned and expected loss as far as India is concerned.
Praveen sir, on similar lines, for creditors, or I can say trade payables, if there are no transactions or movement in the creditor's account for more than 3 years, so should we transfer the creditor's balance to the balance return of ledger? Like, will it be income for the company? Because when we write back the creditors.
Last time the question was that no.
13 years.
10 years. And we said that we will not go near to that balance sheet. So, like I had mentioned in the beginning also, you have to see case by case and situation by situation. There may be a long contract. There may be a government involvement in those. So there may be a situation where you cannot take them into income. There may be a situation you may like to take that into income, but it will depend on circumstances of each case. So as an accountant, you have to make a detailed note why you are treating it like that. And as auditors, you are supposed to ask a question whether you have taken it into income, why? And if you have not taken into income, why? So both sides of questioning has to be done, and it has to be documented, and it has to be demonstrated to the regulator that you applied your professional skepticism and you questioned the company, and then you got satisfied, and this is where your opinion is.
Can I just add to
Yes.
that? You know,
Yes.
firstly, I would want such creditors who don't ask for payments. I would be very, why would a creditor not ask for a payment? So please, first of all, go behind that transaction. It is not just about income recognition. Why would someone not? I mean, is this some way of siphoning off, somebody you owed? Let's say somebody gave me a loan. I was supposed to repay, but I'm not going to repay now or whatever, right? This thing, I mean, you said creditor, right? Creditor could be a trade creditor or a lender, whatever. Is it a way of siphoning off of funds? Why would a creditor who is so charitable that they don't want their money back? Okay, so please look at the business.
Problem is when the auditor asks from client why you are not paying or why is not demanding, he gave a confirmation from the creditors like okay, this is the.
Then if there was a due date if it was a due date for payment, what are you waiting for? Make the payment, na? So if there was like you asked a question earlier that there is a due date, right? Yes. Does anybody say you have a 3-year credit period to make the payment? So if you, what is stopping? Why are you waiting for someone to follow up? So I would actually be very wary of, I'm not saying that you can't write them back or whatever. I would be very careful. Absolutely. One, I am not, let's say if you say, no, the issue is I don't actually have the money. Okay, I am financially in trouble. One is I'm financially in trouble and then I write back and I show such a good picture of my P&L. Wow, suddenly my profit has increased. I would be very careful on those. And also you have to look at the law of limitation, right? Law of limitation, till when do they have a right? Especially in Ind AS and AS, I think in both, you'll actually have to see has derecognition happened. So has the other party, can have they really lost their ability to kind of have a claim? So this is not a frivolous question. There's a very, I think 3 years, 4 years. 3 years is that limitation period? No, it is not. One is, of course, I'm just saying writing back is a high hurdle. Absolutely. Okay, it's a high hurdle. You also need to see why is this not settling? Yes. And
so So there is a in small and medium practitioner, I think this question comes in when they are dealing with the clients who are having that entry business and, okay, I'll just park that entry into your books of accounts and those kind of situations.
All the more a reason, then you should capture that.
Yeah. That's where this, putting that qualification or putting that comment in your report becomes very, very important because you have to be careful. It's not casually, it's not a casual question. It's a very, very important. It's very, very important.
I would be very careful on this. Yeah.
Next question from you, ma'am. Should bank guarantee charges for unexpired beyond the balance sheet date?
I don't think we have time. That would take time.
This question will take time.
This will. Because I don't want to do something in 30 seconds, which would have information.
Absolutely agree. Absolutely agree on that. So we can take smaller questions, which
Asha, I think
today's
our other call is starting. So even my call is starting. It was at 8:30.
So we can take just one or two few questions which are there in the chat box.
Okay, which one do you want to take?
I think we can take this from, if nothing is mentioned on the invoice.
I think we've covered.
Yeah,
We've said aging, take it from the date of transaction.
Operating cycle has nothing to do with this.
I do not know how does operating cycle impact aging? That is into current and non-current. It doesn't impact aging in that context.
Okay, one last question. Sir, can the subsidiary in a different jurisdiction have a different financial year?
That we covered.
Yeah, we said it can be done. Yeah.
Okay, so we are already at 8:30, and as Sir said, we also have another call. So we will close with this, and I won't ask anything else you want to share because we are already
I think
past our time.
next time you have lesser number of questions and we can discuss
It will
more.
it will always be have these type of questions whenever we get to discuss. So with this, we end our today's panel discussion and hope all our audience must have liked it and have gained some knowledge and the learning experience too. And in case of any future reference, you can always watch this webcast not live but on ICA YouTube channel again and again as many number of times you want to. So with this, we will be closing our session, and I would like to take this opportunity to give a formal vote of thanks to both our panelists today, Archana ma'am and Praveen sir. Thanks a lot for giving your time and explaining whichever question we put to you in a very detailed manner. And thanks a lot to the ASB, Chairman Sir, Pramod Jain Sir in absentia, Abhay Sir in absentia, and the entire team of ASB for organizing such a wonderful webinar. And we hope ASB will continue hosting these type of seminars, which are very much useful to each of us. And with this, over to you, Shalini ji.
Thank you, Asha ji. And I wish on behalf of ASB we can have more such enriching and informative sessions. And with the response which we are getting with every webinar, we are getting the responses. And I'm really thankful to all my panelists who have been very sincere and knowledgeable to take up these queries and answer to to the best of their abilities. So thank you, ma'am, and thank you, sir, for sparing your time. And I wish a very, very thanks for the viewers of our sessions who have joined, who have shown their interest in the knowledge dissemination activities of the ASB. And we are there for many more such webinars. And I think I should close here. And thank you, everyone, for being here. Thank you.
Thank you so
Thank you.
much.
Thank you.
Thank you. Thank you.